Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So let's talk about Canada. We had Bank of Canada come out, do another rate cut today. This is the third rate cut in a row that Canada has been doing. Now, we saw that the overnight rate previously before this rate cut was at 4.5%. It's now sitting at 4.25%. So that's a 25 basis points cut. The markets before this meeting was pricing in a 76% chance of a 25 basis point rate cut and a 24% chance of a 50 basis point rate cut for this meeting. However, they went with the expected of 25 basis points, and you got that today from the Bank of Canada. Now, a couple of points to discuss of what Bank of Canada said in its meeting today. So let's talk about a few important points. First things first, they talked about the United States and they said that their economic growth was stronger than expected, led by consumption, but the labor market has slowed. Why do they care about the United States? Because whatever happens there does have an influence on the Canadian economy. They say that when the US sneezes, Canada catches a cold, right? Goes on to say, Bank of Canada says inflation in US and European regions continue to moderate. Preliminary indicators suggest that economic activity was soft through June and July. The labor market continues to slow down. Jobs are getting worse off. Wage growth remains elevated relative to productivity. High shelter price inflation is still the biggest contributor to total inflation, but is starting to slow. And we will see that as we tip into this recession and as this recession gets worse off. A key line that came out was they said excess supply in the economy continues to put downward pressure on inflation, while prices increases in shelter and some other services are holding inflation up. Governing Council is carefully assessing these opposing forces on inflation. Basically talking about saying that even though shelter inflation continues to be elevated, the other components in the CPI report, in the inflation report, is coming down because you're now seeing that supply increase. Go check out if you're out in the market trying to look for a vehicle. Go check out some of these lots. You will start to see, because of a lot of these car dealerships that are getting an increase in supply, you'll start to see these prices come down because of the increase in supply. The opening statement from Macklem highlighted a meeting-by-meeting approach, basically saying that headline and core inflation have continued to ease as expected. As inflation gets closer to target, we will want to see economic growth pick up to absorb the slack in the economy, so inflation returns to the 2% target. Overall weakness in the economy continues to pull inflation down, but price pressures in shelter and some other services are holding up, like we mentioned. We will continue to assess the opposing inflation. We'll take our monetary policy decisions at a time. So they want to continue to see the data. They want to continue to see if anything's getting worse off before doing any of those 50 basis point rate cuts, right? That's what you want to watch out for, is those big 50 basis point rate cuts, 75 basis point rate cuts. If things escalate, they get worse off. You want to basically make sure that if that thing is happening, if you're getting those emergency rate cuts, basically it's telling you, it's not going to look good down the road, right? There's a reason why they do emergency rate cuts. So they haven't done that. They've done the 25 basis points, but we're seeing a case slowly get built up for those emergency rate cuts to come soon. Business layoffs remain moderate, but hiring has been weak. So there's acknowledgement of the labor market is weakening. And with inflation getting closer to target, we need increasingly guard against risk that the economy is too weak and inflation falls too much. So basically from this, let's see if there's any other points as well. Oh, I forgot to mention this. We did discuss scenarios where it would be appropriate to cut at a slower pace or by 50 basis points. 50 basis points. So that line there saying that cutting at a slower pace, which is 25 basis points, which is maybe skipping a meeting of rate cuts, or 50 basis points. I think, my honest opinion, I think Macklem put that in there to basically try to show that, you know, they're not to alarm the market, saying that, you know, we're going with aggressive rate cuts and there's some problem there. Basically opening the door, saying that we could, you know, not go really fast with these rate cuts like the same way how they were hiking rates back in 2022, right? But I call BS on that because the labor market is getting worse off. And if you go at a slower pace, and we have yet to see the damages of all those rate hikes, eventually you will speed up the pace. And yes, you know, if you do cut significantly and nothing happens, you can slow down and pause for a bit before doing additional rate cuts, right? But if something breaks by then, you're going to get the 50, you're going to get the 75, you're going to get those emergency rate cuts. If the economy was significantly weaker, or inflation was significantly weaker, it could be appropriate to take a bigger step. Basically penciling in and giving you the door, saying that, hey, guess what? If we tip into that ugly hard landing, we could come out and do emergency rate cuts. Especially if, like you said, significantly weaker in terms of the economy and significantly weaker in terms of inflation, right? Now, if inflation comes significantly weaker, that basically means the economy is significantly weaker also. Okay, we just look at history, we tend to see that. So the Canadian dollar did pop up. We did see the Canadian dollar go up on that news. The markets are still pricing in more rate cuts to come. The market's pricing a 93% chance of another 25 basis point rate cut in October. Yes, we're going to get that. And I believe the next meeting after that is December. We're probably also going to see another 25 basis point rate cut there. So we started the rate cut cycle right there, right? So we've already did 3. We're going to do a 4th one, a 5th one. We're going to get those rate cuts. Then 2025 comes. We'll see where the data is by then, right? You can get Bank of Canada continuing its rate cuts, maybe slowing down or escalating if shit hits the fan, right? So I've been saying this for quite some time on this channel. It's happening. We're seeing it. Canada was among the first banks out there to go out in terms of the Western countries to go out and start cutting rates quite quickly, and we see that, and that's a signal for the U.S., which we're going to see also this month, to start its rate cut cycle as well. So the expectation is a 25 basis point rate cut in September. Some are thinking we might see 50. Again, depends on that job market. Depends how bad this gets. It starts slow, and then all of a sudden it's going to come and hit hard. So it's happening. Keep an eye out on this. We're seeing in the markets already, the bond market move up higher in, I'm talking about the U.S. Treasury bonds. We're seeing the equity markets, the stock markets sell off a little bit here. Saw a massive sell-off yesterday. A little bit of choppiness today with more of a downside pressure there. But we're seeing the bond markets pick up, especially because of the JOLTS number that came out today, saying weak hiring there. And we've got jitters. We've got the VIX picking up, right? It's sitting at around 21 right now. So fear. We've got a lot of data this week, especially to look out for. We've got inflation data as well. Then we got the Fed meeting, elections coming up. You're going to expect some volatility for the next coming months, especially with the elections. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified next video, and I'll see you guys around. Cheers. Bye.